We talk a lot about investing in Canada and the U.S., but one of the biggest equity stories this year comes out of Japan, where stocks have climbed to their highest level in 3 decades. There are a few reasons for the climb, but on the simplest of levels, some experts say that market may have been undervalued, due perhaps for some buying. And it has helped that one of the world's best-known value investors, Warren Buffett, has made a huge bet on some Japanese stocks, notable considering he's known historically as the Buy America investor. For more on the Japanese market performance, we're joined by Drummond Brodeur, Senior VP and co-head of macroeconomic and FX strategy at CI Global Asset Management. You started your career in the late 80s as a Japan equity analyst. What do you make of what's been going on?
I did, and so, yeah, well, perspective sometimes counts. So when you look at when I started, the Nikkei was still on its way up towards an all-time high, just shy of 39,000. The end of 1989. So we're hitting new 3-decade highs as it gets back to 30,000. That's still way below its all-time highs. And so, you know, it's a great headline, hits a new 30-year high, but what has it been doing for 30 years?
Okay, well, that's
the part of the problem. It's not a good thing when you're sort of climbing those highs from 30 years ago.
Real patience among investors.
No
okay,
kidding.
Let's start with that part. So what was the challenge for all the years in the first place?
Okay, well, first of all, there was a huge asset bubble there that happened and burst. Not completely dissimilar to 2008. Never basically fixed the problem, never recapitalized the banking system. So you went into basically a disinflationary stagnation for 30 years. So growth, there's been no growth. Nominal growth has been flat over 30 years. Japan is very unique in a lot of levels. I mean, it's a shrinking population, shrinking workforce. So growth potential still remains very low. And then when you look at from a company point of view and an investor point of view, it's just not a shareholder-friendly culture. Now, we start at very, very high valuation levels. Part of it has come down. But so valuations are more reasonable, but it's a much lower returns, lower growth rate potential versus sort of North American companies in particular, and even European ones to a degree. And as I say, the management culture isn't to return capital to shareholders. It's much more stakeholder oriented. So it's kind of been a stagnant economy and market for past of the 30 years. And every 10 years or so, we call in, Japan becomes, a flavor of the month again, and you do get a big, hey, it's going to change, it's going to be different. Remember Abenomics, which is about a decade ago in 2013 when that started. And it just does drive a lot of flows into Japan, get some excitement going. But Japan doesn't really follow through on the structural changes that would say it really is different this time. And so we're seeing a bit of a repeat this time. But those can be very powerful rallies, particularly since you're starting at valuations that are reasonable, companies that are massively cash rich, even if they won't return that cash to shareholders. And what you see really drives the Japanese market when you get these sort of big rallies. It's always the foreign investor flows flowing in and out. And so that's what we're seeing driving the market again today. It's foreign money going into Japan, but very, very underweight. And so this narrative that Japan is changing, Warren Buffett, Pied Piper, go there. Okay, let's follow. And it just drives a wave of capital into Japan. And that's historically really what drives a lot of these rallies. With the caveat, though, often when you get these big rallies in Japan stock market, we see the yen weakening as well, so which helps earnings forecasts. But of course, if you're a foreign investor, if you haven't hedged your yen exposure, you go up, market goes up 20%, and then yen goes down 15%. It's a more modest return than it would look like.
Well, that's helpful context. So maybe a bit of buyer beware after the big rally we've seen. Now, you also track China very closely. And for the broader markets in the world, China's been a complicated story. And it rubs off on all assets, oil, et cetera. A lot of people thought the China recovery was going to be one of the drivers this year. And every day we seem to get these headlines suggesting they're having some fits and starts with the economic picture. What's been your observation?
I think all of those are right. I think it was overly optimistic about in terms of the stage of the recovery or the scale of the recovery we'd see in China. Our view was that China was going to be a recovery driver as a reopening trade. But that reopening trade was really about Chinese consumers, getting back, let out of home, lockdown, opening up, going out and traveling, going to restaurants, seeing friends, family. So very much domestic demand, consumption driven. That's not what Chinese rallies in the past have all been, or economic growth. It's been driven by infrastructure spending, construction spending, property spending, et cetera. And so that drives a huge global impulse. into the sort of the global community. And a lot of people looking at past behavior of Chinese recoveries were kind of expecting that same sort of pattern. Hey, here's what happened last time, so this is what we should expect. We've always been more circumspect, saying, no, this is domestic demand driven. It's not commodity intensive. They're trying to delever a lot of that excess spending on the sort of infrastructure and housing side of it. But you are seeing that estimates for growth have definitely gone up, all driven by domestic demand, consumption, but it's very different beneficiaries of that. And as I say, it's much less of a impulse than if you do get a big infrastructure fiscal spending driven push, which is not what we're going to see this time. So some disappointment over what were overheated expectations. And then there have been some other more muting effects. Obviously, the U.S.-China relationship, global relationship with China not helping. This is a longer-term structural issue. But a lot of this sort of adds to just sort of a kind of a malaise as people look out over China. And that's actually one of the factors that helps Japan, ironically enough, because a lot of portfolio managers, once again, when I talk about portfolio flows going on, what are the big markets over in Asia? It's China, it's Japan. And so if a portfolio manager, a global asset, is allocating sort of on to Asia, and China's less attractive or more concerns, they look and say, hey, here's a more positive story in Japan. So it can drive flow of funds, even while it's not separate from what the underlying fundamentals might be indicating. So it does affect market performance, for sure.